On this last trading day of the month and quarter, I want to take a closer look at the surge in IPOs. There have been 105 IPOs so far this year, and 28 of them have been in the month of June. Now, the last time we had that many in a month was 3 years ago. Here to talk about what is driving it is Kathleen Smith, principal of Renaissance Capital, a manager of IPO ETFs. Kathleen, it's great to have you with us.
Thank you.
What is behind this? Because the markets have been sort of in a sideways pattern for this year.
Well, IPOs are on fire, and these returns are the best for the first half that we've seen. You'll have to go back to 2014 when Alibaba went public with its $22 billion IPO. And we think that a lot of the reason is that there's some pricing discipline in the market. The average IPO is priced at 15% first day pop. You know, back in the internet bubble days, those first day pops were 50 to 70%. And the average IPO is being priced at the midpoint of the range. But it really is all about the returns. Returns are the fuel that drive the IPO issuance.
What does this tell you about the risk appetite in the market? Because what we've seen in the S&P 500, for instance, is technology leading the way. So the risk appetite seems to be there in the markets, even if the markets are going sideways. So does that bode well for the IPO market?
Well, I think you have to look at, yes, the risk appetite certainly helps IPOs. And then IPOs generally are technology, healthcare kinds of growth companies, and those have been a favored sector of this market as investors are looking for real growth and sectors that maybe can withstand some of the turbulence that's happening with the tariff issues and things like that.
When you hear CEOs of young companies say, I don't want to go public, it's not part of my plans, what is your reaction to that? Do you think they're being naive and ultimately they'll come around, or are they sincere about it, or what?
I think that a lot of that narrative relates to the amount of capital that's in the private markets, and these companies have been able to delay going public. We know that that doesn't always continue, and another thing is these companies are afraid to take a discount on their IPO, a down round from the private round. Now, today we saw a company come public called Domo. Domo had a valuation of $500 million. A year ago, its private valuation was over $2 billion.
Wow. So
the company priced last night is trading today up 23% or so, called Domo. I'd like to rename it Major Domo. This is an incredible,
right.
But what they've had to do.
$2 billion in the private market, so they said. And then when the rubber meets the road in the public market, it is worth a quarter of that?
A quarter of that, I think.
The total value?
The total value.
What happened?
We have a lot of private companies that are disconnected in valuation from the public market. And that is basically when the public market is doing what it's doing now.
There's too much money in the private market. Isn't that what it is? Interest rates are low. They can't get a return, so they think they're going to get something better from these. They're praying for unicorns.
They're praying, and we are getting unicorns. Maybe not the Ubers, but there are unicorns coming. The issue is the IPO market is doing so well that we would say that if you're a company that is look at this market, if you're delaying going public because you're trying to adjust for valuation, take the hit, come on out, and get public while the getting is good.
The other way to ask Tyler's question, I was thinking the Norwegian Sovereign Wealth Fund earlier this year asked for permission to buy private equity. And their finance minister said no. The reason they wanted to buy private equity, they're only allowed to buy public equities. And they said from when they started the fund to today, the number of public equities in the entire world is down 50%. There are just fewer public equities in the world. Why is that?
But the returns on public equities have been phenomenal.
Yeah, but the question. But the question.
But so why wouldn't there be more?
Why aren't there more?
We're starting to see that. It takes time for markets to adjust. Interest rates go up. The amount of money that's in the private market is going to end up contracting over time. We're in a cycle.
Are private equity companies that are taking businesses public a part of this phenomenon or not? In other words, if they're trying to cash out?
Certainly. What we're finding is that in the private equity area, which consists of venture and the leverage buyout types of companies, they're invested in portfolios that have not been fully liquidated in their normal time. We're seeing companies that have been sitting in their portfolios for 10, 11, 12 years. We know that they have to get liquid and return money to their limited partners. Right. So what we're seeing is an acceptance of the reality of what the liquid market requires in terms of valuation. compared to the illiquid market, which may have a much longer time frame,
Sure.
but it's not seeing real liquid valuations.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.